Welcome back to The Explainer. So today we're diving into what is arguably the ultimate picks and shovels play of the entire artificial intelligence gold rush, Tokyo Electron. When we talk about AI's explosive growth, we're usually obsessing over the chips themselves, right? But to actually make those chips, you need some seriously specialized, insanely complex infrastructure. Enter Tokyo Electron, or TEL. They are Japan's largest semiconductor equipment maker and a top 3 global player in wafer fab equipment. Basically, they're the foundation that's making this entire AI revolution possible in the first place.
Okay, let's dive into this. 91%. Just let that number sink in for a second. In a hyper-competitive global tech landscape, snagging a 91% global market share, that's not just participating, that is absolute, undeniable dominance. It's literally like owning 91% of the toll roads leading into the AI city. In this specific segment of the market, they basically are the market.
But, as we all know, market dominance today doesn't automatically equal a flawless stock tomorrow. So, the main question we really need to answer by the end of this explainer is pretty straightforward. With everything constantly shifting in the semiconductor space right now, is Tokyo Electron a screaming buying opportunity for your portfolio, or are the inherent industry and geopolitical risks just way too high?
To figure that out, we're going to break this whole dynamic down into 4 clear parts. First, the AI infrastructure giant. Second, the bull case. Third, the bear case. And finally, valuation and our final verdict. Let's get right into it.
Starting right off with part 1, the AI infrastructure giant.
To really grasp the TEL investment thesis, you got to understand what they actually build. Their core business revolves heavily around etch and deposition equipment. These are the absolutely critical processes for manufacturing next-gen AI memory and advanced logic chips. Without TEL's specialized gear, the physical architecture required for modern AI it can't be manufactured at scale. But here is the real secret sauce: ecosystem lock-in. TEL's coder and developer systems, where they hold that massive 91% share we just talked about, generate around 500 billion yen in annual new equipment sales. And these systems are tightly, inextricably paired with ASML's lithography tools. Because they are so deeply baked into the ASML ecosystem, it creates this incredibly powerful, super hard to disrupt market dynamic. And this lock-in is driving phenomenal demand, actually securing a projected 50% or more year-over-year growth for their 2027 outlook in this segment alone.
Which naturally brings us to part 2, the bull case.
If you're an AI optimist, this is where the upside lives. The fundamental argument here is that the AI semiconductor build-out isn't just continuing, it's accelerating. And this brilliantly illustrates that point. TEL projects that the overall wafer fab equipment market is going to grow by 15% in calendar year 2026. But break that down and look at the specific drivers. DRAM is projected to grow at roughly 20% and leading-edge logic at 15%. Because TEL's absolute strongest positions, like those coder/developers and interconnect edge systems, are completely indispensable for these exact segments, they're perfectly positioned to just surf this massive wave of capital expenditure.
But TEL isn't just resting on its laurels with its current dominance. They're aggressively pushing into totally new growth vectors. A huge standout is their new cryogenic etching tool launching this year. By basically deep freezing the process, it hits a 2.5 times faster etch rate than conventional equipment. And what's amazing about this is it lets TEL crash into a 3D NAND segment where they previously had zero market share. Going from literally zero to having a highly competitive, lightning-fast tool, that's a huge deal. Plus, their bonding equipment is moving beyond just high-bandwidth memory, or HBM, into NAND bonding and logic backside power delivery networks. They're expanding their total addressable market in a very real, tangible way.
On top of all that operational growth, they are directly rewarding investors right now. They recently wrapped up a massive 150 billion yen share buyback, and they've bumped their annual dividend up to 364 yen per share, up from 327 the prior year. All of this is backed by a super aggressive, highly shareholder-friendly 50% payout ratio target. And honestly, the financials are totally backing up this narrative. TEL has been showing some remarkably solid earnings momentum. Look at their full-year FY 2026 results. Net sales came in at 2.44 trillion yen, with a net income of 574.5 billion yen. The big takeaway isn't just the sheer size of those numbers, it's that they easily crush their own revised guidance. On top of that, management is projecting strong confidence in hitting their 593 billion yen operating income target. If you're running with the bulls, this is exactly the kind of financial execution you're looking for.
All right, let's flip the coin and move into part 3, the bear case.
Because we have to systematically evaluate the very real geopolitical and financial headwinds staring Tokyo Electron down right now. The single biggest vulnerability sitting on the horizon? Geographic exposure. Notice this slice here representing China? It currently makes up roughly 30% of TEL sales, but that's actually a pretty significant drop from nearly 39% previously, and as U.S. export controls systematically tighten, the downward trend is fully expected to continue. Now, TEL is scrambling to offset this missing revenue by improving its product mix toward higher-margin tools globally, but there's absolutely no guarantee they can pivot fast enough to perfectly plug a hole that large. Now, what's really interesting about this slide is the profitability pressure, especially when you contrast TEL against a major competitor like Lam Research. TEL's gross margins have actually deteriorated over a cumulative 3-quarter period, sliding from 47% down to 44.7%. This is mostly being driven by rising costs of goods sold and higher operating expenses. A big reason they lag behind Lam in operating margins really comes down to their service mix. Only 26% of TEL's quarterly sales come from those juicy, high-margin services, whereas Lam sits comfortably at 36%. And yeah, TEL's management has a strict policy to price new products above existing benchmarks, but actually executing on that pricing power in a hyper-competitive environment, that is a distinct risk.
Speaking of execution risk, we need to take a sober look at their new product pipeline. Yes, that cryogenic etching and the bonding tools we hyped up earlier, they are incredibly exciting. But they are still very early-stage revenue streams. Compounding that uncertainty is the fact that management hasn't even provided full-year FY 2027 guidance yet. They've only given us first-half numbers. And in the semiconductor industry, a lack of full-year visibility often suggests management might be quietly bracing for some demand volatility.
Add to that the broader macroeconomic picture. The semiconductor equipment industry is notoriously and sometimes brutally cyclical. If we see a prolonged pause in global equipment orders, especially if that pullback in China accelerates, that would weigh heavily on TEL's results. And remember, TEL's current valuation already has a whole lot of growth baked right into the price. Analysts are definitely taking note. In August 2026, Zacks Research actually downgraded TEL to a hold, which clearly signals some caution brewing in the professional analyst community.
Okay, let's synthesize all of this in part 4, valuation and final verdict.
So, despite those bearish risks, the broader analyst community has actually been raising price targets for TEL over recent months. The average target is now sitting somewhere around 50,000 to 54,000 yen, implying clear upside from current levels. The ultimate bullish narrative projects an astounding 3.9 trillion yen in revenue and 970 billion yen in earnings by 2029. But hitting those 2029 numbers requires a seriously demanding 17.5% annual revenue growth rate. Given the trajectory of AI, it's certainly not impossible, but a 17.5% annual hurdle rate, that is a very steep mountain to climb without stumbling once.
Which brings us to a concrete decision framework for you. It's highly personal, based on your own risk tolerance. If you confidently believe that the AI infrastructure build-out is just going to keep roaring unhindered through 2027 and beyond, well then TEL's 91% market share in coder and developers and their huge DRM exposure makes this a highly defensible, premium play that absolutely justifies the valuation. But if your risk tolerance gets a little tripped up by that China revenue decline, the creeping margin pressures, or just the historic, violent cyclicality of the equipment industry, then you might want to look for lower risk opportunities within the semi-space.
So, based on the source material we've broken down today, the ultimate verdict positions Tokyo Electron as a strong buy on weakness candidate, particularly if you have a 2 to 3 year time horizon. Because of the macro risks, position sizing is absolutely critical here. You have to actively monitor those quarterly order trends, paying really close attention to China and how the customer makes shifts toward advanced nodes before going all in. This is definitely not a set it and forget it stock. At the end of the day, it all comes down to a test of conviction. You've seen their absolute, undeniable dominance in key markets, and you've seen the very real geopolitical speed bumps lying right in front of them. So I'm going to leave you with this. Are you willing to weather the inevitable, cyclical storms of the semiconductor industry in order to own the foundational infrastructure of the AI boom? Thanks so much for joining me on this explainer, and keep learning.